Now let's look at the income statement. So now we will focus on the income and expense account in the trial balance. And those are reflected in the income statement as follows. Again, a very, very simple basic income statement. One important distinction between a balance sheet and income statement that we need to understand is, as you can see, income statement is for a period. So it is a summary of the transactions for a given period. And in this case, we are looking at the full month of January. So all the transactions that impact income and expenses for the month of January, we see the net result here. However, balance sheet is at a given point. So this balance sheet shows the balances, shows the assets, liabilities, and equity as at January 31st, right? So it's a snapshot. It's as if somebody took a picture of the situation at the end of the month, and that situation shows that the company has balance in the bank or in hand of $8,300. The company on 31st January has inventory of 2,500, and the same for furniture, equity, and retained earnings. However, income statement shows the impact for the period. So in our example, we only had one transaction on the 23rd of January, which is resulting in sales of 4,000. But if there were other transactions for the month of January, they would all be summed up together and shown here. And the same applies for cost of sales, other operating expenses, and other income. Okay, remember the distinction. Income statement is a report for a period, and balance sheet is a report for a given point in time. And an example that you could think of is that if I ask you what is the bank balance that you have in your bank right now, and if you check your bank account and tell me the balance, that is the balance sheet. But if I ask you how much money have you earned during this year in the last 12 months, so that total money in that 12-month period, that would be something that would reflect in an income statement. So that's the difference between a period report and a point in time report, right? So income statement is a period report, balance sheet is a point in time report. So we can see in this example, we had sales of $4,000. We also recorded cost of sales of $2,500. That makes our gross profit of $1,500. So gross profit is really the amount of money that we earned on a net basis after deducting the cost of selling a product. So gross profit is strictly related with the product itself. And then if you add other expenses, operating expenses, and other income, then you get to net income, right? In our case, the operating expenses were $1,200, which is really only rent in this case. And then other income reflects the dividend income that the company received of $500. So in total, the company made $1,500 in gross profit, but then after deducting operating expenses and adding other income, we have net income of $800. And this $800 of net income will be reflected in the balance sheet as retained earnings. At the end of the year, all the income statement accounts are settled and turned to zero, and that balance is transferred to the balance sheet in the retained earnings account.